How much money can an S Corp actually save you in taxes? It could save you thousands of dollars, but it could also cost you more than it saves. I want to show you with spreadsheets how this works and specifically at what income it starts to make sense and when it doesn't. Let's jump in. Okay, don't freak out. This looks stupid, but I'm going to make it easy for you. We're going to start here on the left side. This is what it looks like if you have not elected to be taxed as an S Corp. If you're just taxed as a regular LLC or even not as an LLC, you're going to have all of your business income minus your business expenses. When I'm talking about business expenses, I'm not talking about the amount you pay yourself. I'm talking about your software, your inventory, your advertising, your actual business expenses. You're gonna be left with your net business profit. Whether or not you leave that money in the business or distribute it to yourself as owner's pay does not change how it's taxed. It's all taxed the same exact way. So that $100,000 that you had left over, we're going to drop that down here. This is how much you're taxed on. Now you're going to be subject to two different types of taxes. One is your regular income tax. This is the same income tax that you're going to pay on any other kind of income you have, whether it's W-2 income from a day job, interest income, other business income, whatever it is, you're all going to get taxed on that same income tax rate. Let's pretend that that tax rate for this purpose is about 20%. And then the additional tax that you're going to have because you're a business is self-employment tax. Let's type that out so that you can see it. Self-employment tax. That self-employment tax is another 15%. It's actually 15.3%, but let's make the math easy. And that 15% is the government's way of making you pay Social Security and Medicare on that business income. Because if that business income had been earned through a W-2, you'd have had 7.65% withheld from your paycheck for Social Security and Medicare, and your employer would have matched that same amount on their behalf. So you would have had a total of 15% being paid on your behalf for Social Security and Medicare. As a self-employed person, you're paying both portions of that here. So the total tax rate that you're paying specifically on that business income is going to be about 35%. And again, that's going to depend on what your income tax rate is, and we're pretending that it's 20%. So 20 plus 15 gives you 35. So your total tax rate here is 35%. If we take the $100,000 times 35%, you're paying total taxes on this of $35,000. And that's just federal. That does not count state taxes. So $35,000 would be the taxes you owe if you're not an S Corp. So where do you save taxes if you do get taxed as an S Corp? You save taxes on this self-employment tax. Whenever your business is taxed as an S Corp, you don't pay that self-employment tax on a portion of the income. So let's see what that actually looks like. I'm going to scroll over this direction and we'll look at the same thing, but in an S Corp. So same thing, income of $150,000, expenses of $50,000, left with a profit of $100,000. And again, this is the profit before paying yourself anything. So let's say of that profit, you leave in the business $50,000, or you just distribute it to yourself as a distribution, $50,000, and you pay yourself a salary through payroll of $50,000. Now, why would you do that? You would do that because you have to do that. The government requires that you pay yourself a salary. When you're the owner of an S Corp, you have to pay yourself what the IRS calls a reasonable salary for the work that you do in the business. The issue is that the IRS does not define what a reasonable salary is. There's no calculation for it. Essentially, it's whatever you would pay someone else to do the same job as you. So in this example, I'm just splitting it evenly. I'm saying that of the $100,000 that we had left over in profit, we're going to say that $50,000 of that was the payment for the work that I did in the business as an employee, and the other $50,000 is just the distribution I'm going to take, or I leave it in the business, one way or the other. Now, each of these pieces is going to be taxed differently. So let's start actually with the $50,000 that we're leaving in the business or distributing to ourselves, because that part looks exactly like it does without the S Corp. So we're going to drop that piece down here. And that $50,000 is still subject to our same 20% income tax rate, but it's not subject to self-employment tax. And so we have that 20% of the $50,000, that's $10,000 of tax from that. Now, what about this $50,000? This $50,000 salary is still going to be subject to your normal income tax rate, but it's also going to be subject to payroll taxes. And remember, those payroll taxes are the same exact thing as self-employment tax. So that's another 15%. So you're still paying that 35% on the part that's a reasonable salary, but you're only paying 20%, or whatever your normal income tax rate is, on everything else. So on the $50,000 salary, you'll pay $17,500 in taxes. On the rest of it, you'll pay $10,000 in taxes. So you'll pay a total of $27,500. So if you look at it right here and you come down, we'll see that that saves you about $7,500 in taxes. So you think, well, great, that sounds awesome. Let me do that. The issue is you have some other costs that you're going to have to pay whenever you have an S Corp. What are those costs? Well, one thing, you're going to have a payroll tax service. Since you have to have a salary, that means that you're filing quarterly payroll tax returns, you're issuing a W-2 to yourself, and unless if you feel like filling out those payroll tax forms yourself and getting them filed every quarter, you're going to want some sort of payroll service like Gusto or QuickBooks Payroll. I suggest Gusto. They're all about $45 to $50 a month, even if it's just for one person. And so I'm putting here 45 times 12. That's going to take $540 off of that tax savings. In addition to that, since now you're being taxed as an S Corp, you have an additional tax return. So over here, whenever you weren't an S Corp, you just have one tax return, your personal tax return. And your personal tax return has all your business income and expenses on it. But whenever you're taxed as an S Corp, you have to file a separate tax return specifically for the business. TurboTax will charge you at least, I think it's a minimum of $1,700 for an S Corp tax return, and do not use TurboTax to file your S Corp tax return. So let's just say it's $1,500. That's a very low number, but we're assuming that maybe your personal tax return doesn't cost as much anymore because there's no business on it. I don't know. Let's just say it's $1,500. This is low ball. In addition to that, you're going to have some sort of bookkeeping in place. Whenever you're an S Corp, it's really important that all your books and records are in place, even more so than if you're not an S Corp. And so let's say the bookkeeping is $500 a month times 12 months. That means your total costs to have the S Corp is about $8,000 and you're saving $7,500. So your net savings is actually a cost. It cost you more than it's saving you, and now you're in the whole $540. Even if we adjusted some of these numbers, let's say you could find pretty cheap bookkeeping for $350 a month, you're still saving maybe $1,200, but you might actually have other taxes due, like workers' comp and unemployment, depending on what state that you're in. So at this point, we're virtually break even. And this is why I usually tell clients that we start having the conversation about the S Corp whenever you're profiting about $100,000 before paying yourself or distributing anything to yourself. It's because that's the point at which an S Corp election would probably get you at about break even. So now it makes sense to start talking about it, talking about your plans, talking about the future, and seeing if it makes sense for you. So let me show you two other examples of this. One is going to be where it definitely does not make sense, and one where it might make sense. Let's look at the one where it does not make sense. This is the same exact stuff, so I'm not going to go through line by line, but all I did was change the numbers here from, instead of being a $100,000 profit, we're now at a $50,000 profit. So let me zoom in here. Same thing, $50,000 profit. We leave or distribute $50,000. We're taxed normal tax rate, self-employment tax. Now we're paying $17,500 in taxes. If you have an S Corp though, then same $50,000. Let's split it in half and take a $25,000 salary and leave the other $25,000 either in the business or take it out as a non-taxable distribution. Same exact math, 20% on the distribution, 35% on the salary. So the total tax is $13,750. Scroll down here, your savings of $37,500. You still have the $540 for payroll services. You still have the payroll tax return. You still have bookkeeping. You're in the hole now, $4,300, because it cost you way more than it's saving you in taxes. This is why it does not make sense to make that S Corp election too early. I would also point out that if you're working full-time in your business and you're trying to argue to the IRS that your salary should only be $25,000 for a full-time owner of the business who's doing everything, that's going to be a really hard argument to make. If the IRS sees this, they may very well say, actually, this is not 25 and 25. We're going to reclassify those distributions as salaries. And so instead of saying 50% here and 50% here, we're going to put all 100% here. And now you're not saving anything, but you still had all these costs. And so you're even further in the hole. Now, one last thing, let's look to see where this actually makes sense. So this is where, if let's say you've got Let's say you've got $350,000 of income, $150,000 of expenses, you profit $200,000. Without the S Corp, all $200,000 is subject to your income tax rate, which at this level of income, your income tax rate is probably higher than 20%. But because that part doesn't change between S Corp and not an S Corp, I'm not going to worry about changing it. It'll affect both sides equally. S Corp, self-employment tax rate still 15%, total tax rate 35%. That means you're paying $70,000 of taxes on this $200,000 of income. Over here on the S Corp side, everything rolls through. You're paying yourself a $100,000 salary, which to me is very reasonable. You're leaving $100,000 in the business or taking it as a distribution. So that $100,000 that you're leaving in the business, same 20% tax, $100,000 from salary, same income tax, same payroll tax rate. So you're paying $55,000 in taxes. So then the savings between 70 and 55 is $15,000 minus your payroll service, minus your S Corp tax return, minus your bookkeeping gets you net savings of $7,000. Now we're talking. Now there's a clear enough margin here that this very much makes sense. I'm gonna jump out of the spreadsheet now and go over a couple of situations where it still might not make sense to switch to an S Corp even if you have this savings because of other things that I haven't covered just yet. So even if you have significant tax savings over and above your actual cost to have the S Corp, what are the reasons why you still might not want to do an S Corp? One is the complexity. If without the S Corp, you spend personal money on business expenses, it's fairly easy to put those on your business tax return and still deduct those. But with the S Corp, you have to treat yourself as an employee. And so those expenses you pay for the business out of your own pocket have to be reimbursed through an accountable plan as if you were an employee getting reimbursed for business expenses. Another one is retirement options. I won't go into the specifics, but without the S Corp, you just have a little bit more options and flexibility when contributing to retirement to get a tax deduction than you do with the S Corp. And the third reason gets super complicated, so I'm not going to go into the details of it, but it has to do with basis and debt and the way that you hold debt and the way that it's treated in an S Corp versus out of an S Corp. So if you have a complicated business with a lot of assets and a lot of debt, an S Corp might not make sense even with the immediate tax savings. My purpose with this video isn't to scare you away from electing to be taxed as an S Corp. Instead, I want you to have the full picture and know everything that's involved so that you can make the best decision for yourself. If you want a copy of that spreadsheet, I'm going to put my contact information in the description. Just click that and ask for it and I'll send it over to you. No questions asked. I hope that was helpful. Let me know in the comments if that helped you understand how S Corps work and how much they can save you in taxes, and I will see you next time.